Silver crashed to $65 on Thursday or surprised, and while that was happening, physical buyers were still pulling real metal out of COMEX vaults. Not slowing down, not pausing, still draining. The paper price said one thing, the physical market did the opposite. That contradiction is the entire story of this week, and understanding exactly why it happened, why silver can crash 10% on paper while institutional buyers keep demanding physical delivery, is what separates the investors who panic at moments like this from the ones who use them. Curious, here is the complete mechanism. While the paper price was crashing, something else was happening simultaneously that the mainstream coverage is not connecting to silver. Brent crude was surging toward $119 per barrel. The Strait of Hormuz, the 21-mile channel through which 20% of all global daily oil consumption flows, remains effectively disrupted. The IEA has officially described the current situation as the largest oil supply disruption in the history of the global oil market. Here is the direct connection to silver that most analysis is missing. Every ounce of silver that comes out of the ground requires energy to extract. Silver mines run diesel-powered underground haul trucks, electrical processing mills, flotation circuits, smelting facilities, global logistics networks running on fuel. The largest primary silver producers in the world, Fresnillo in Mexico, Pan American Silver, First Majestic, are all facing energy input costs that have surged dramatically in weeks. When oil moves from $80 to above $100, the all-in sustaining cost of producing an ounce of silver rises with it. And when the cost of production rises, the floor below which miners cannot economically operate rises with it. The paper price of silver just crashed to $65. The cost of producing silver is simultaneously rising. Those two things cannot coexist permanently. One of them has to move toward the other, and the direction that resolves is not downward on the production cost side. Now the physical vault data, because this is where the paper price and physical reality have never been further apart. COMEX registered silver inventory as of March 13th, 78.95 million ounces. Registered means physically vaulted, certified, and legally available for delivery against futures contracts today. That is the only real physical backstop behind all the paper silver trading that happens every session. On top of those 78.95 million ounces of real silver, 579 million ounces of outstanding paper contracts. 7.3 paper claims for every single physical ounce in the deliverable vault. Now the drain figures. Over the last 30 days, total COMEX vault inventory has declined by 40 million ounces, confirmed in the March 13th Pure Metals report. 40 million ounces in 30 days is an enormous physical withdrawal rate by any historical standard. Registered inventory specifically has declined 19 million ounces, from approximately 98 million ounces to 78.95 million. In the current delivery period alone, and in the March delivery window, 40 million ounces have already been demanded for physical settlement, against a registered backstop of 78.95 million ounces. Sit with that arithmetic. Now add the delivery history that makes this week's paper crash look even more disconnected from physical reality. January 2026, COMEX recorded more than 49 million ounces of physical silver deliveries. The typical January in prior years, 1 to 2 million ounces. January 2026 saw approximately 30 times the delivery volume this exchange would normally process in a January, not a modest increase. 30 times. February 2026, 25.18 million ounces, the highest February on record. Now ask 5 questions. When the paper price crashed Thursday, did physical buyers stop demanding real silver? No. Did the vault refill itself? No. Did the Strait of Hormuz reopen? No. Did industrial demand from solar, semiconductors, AI data centers, and defense hardware disappear? No. Paper crashed. Physical reality did not move an inch. The structural backdrop underneath this crash is the most extreme in the silver market's modern history. The Silver Institute, the primary global body tracking silver supply and demand, has confirmed that 2026 will mark the 6th consecutive year of structural supply deficit, the 6th consecutive year. Projected shortfall for 2026 alone, approximately 67 million ounces. The 2025 deficit ran between 95 and 117 million ounces. Add the cumulative deficit across 5 years. You are approaching or exceeding 800 million ounces permanently removed from investable supply. More than an entire year of total global mine production. And the demand side of that equation is not slowing. Every solar panel requires silver paste in its photovoltaic cells. Every AI data center requires silver-based connectivity components. Every advanced defense system requires silver for its electronics. Silver was formally added to the U.S. critical minerals list, the government itself declaring it strategically irreplaceable. None of that demand switches off because the Federal Reserve held rates. Citigroup, one of the largest financial institutions in the world, has published a silver price target of $150. Jim Wyckoff, one of the most respected commodity market strategists, stated this year that $65 to $70 represents a fundamentally new support floor and that three-digit silver is no longer an unrealistic scenario. These are not anonymous predictions. These are named institutional analysts writing in research notes. I am not telling you these outcomes are confirmed or guaranteed. What I am telling you is that serious institutional research is quietly pointing at a price more than double this week's crash low. Pay attention to what serious people say quietly. Now what this week means specifically for every type of silver holder. Physical silver holders. Your ounce count did not change this week. The number on your screen changed. Your physical position did not. When paper price crashes play out the way this one did, dealer premiums, the gap between the COMEX spot price and what it actually costs to put a physical ounce in your hand at a real dealer, typically widen rather than collapse. Earlier this year, when paper silver was trading around $95, silver eagles at major dealers were priced between $120 and $130, a $30 gap between paper and physical reality. When paper crashed towards $72, that premium gap widened further, because dealers cannot and will not sell real metal at a price the paper market manufactured. The physical market's premium is its real-time verdict on the paper crash. SLV holders. SLV is a price tracking vehicle. The custodian holding the physical bars is JP Morgan Chase Bank in London. The metal is real, but the price of your SLV shares is set tick for tick by COMEX futures mechanics, not by the bars in the vault. SLV does not give retail investors any right to demand physical delivery. That right is reserved for authorized participants only. What happened to your SLV position this week is not a reflection of what happened to physical silver fundamentals. It is a reflection of what an algorithm did to a futures market in the seconds after a Fed press conference. PSLV holders. PSLV holds fully allocated audited serial numbered physical silver bars stored at the Royal Canadian Mint in Ottawa, audited by KPMG. Nothing Jerome Powell said this week moved a single gram of silver out of that vault. When you see PSLV share price decline, you are watching the paper spot price mechanically pulling your share price lower. You are not watching your physical silver disappear. Those are different things. One signal to check right now. The PSLV discount to net asset value on CEF Connect. If that discount is narrowing while paper price is still suppressed, institutional money is rotating into physically backed structures. They are using the lower paper price as an entry point, not a reason to exit. In January, the PSLV discount actually flipped to a premium during the peak of the physical squeeze. Large, sophisticated buyers paying above the certified value of allocated silver just to get positioned in a physically backed structure. That is the clearest institutional positioning signal available without a professional terminal. One important note for PSLV holders in taxable accounts considering selling at a loss. Before making any move, speak to a qualified tax professional. The PFIC default regime under IRS rules can turn a paper loss into a real and significant tax event. Understand the structure of what you hold before you make a tax decision under pressure. The bear case deserves direct and complete acknowledgement. The Fed dot plot showed at most one rate cut in 2026 with vague timing. If inflation data continues running hot, that one cut gets pushed further or eliminated entirely. A dollar strengthening on rate expectations delayed creates mechanical downward pressure on every dollar-denominated commodity simultaneously. The paper market can sustain a disconnect from physical reality for longer than structural analysis suggests it should. 7.3 paper claims per physical ounce is an extreme ratio. It has been extreme for months without forcing an immediate resolution. The COMEX has tools, emergency cash settlements, delivery deferrals, position limits, that can manage acute delivery stress without the paper price being forced to reflect physical reality immediately. If Chinese physical buyers continue stepping back from the arbitrage spread, the Eastern physical floor under the paper price weakens further, and if oil unexpectedly de-escalates, the production cost argument weakens simultaneously. The structural case is the strongest it has been. That does not mean the paper price cannot go lower before physical reality forces the resolution. Size accordingly. 4 things to check before the next market open. 1. Pull the CME Daily Silver Vault Report. Free public document, updated every trading session. The number you want is registered ounces. If that number is still declining after this week's paper crash, physical buyers are continuing to pull real metal out of the system regardless of what futures are printing. That is your confirmation. Paper trap, not structural breakdown. 2. Check the COMEX futures curve for backwardation. If the nearby spot price is trading above the front month futures contract, that is backwardation. It means the physical market is so tight that buyers are willing to pay a premium for metal right now over metal 3 months from now. You cannot manufacture that signal with paper. 3. Check the PSLV discount to NAV on CEF Connect. If that discount is narrowing while paper spot is still suppressed, institutional money is rotating toward physically backed structures, the most accessible real-time signal of what sophisticated capital is doing. 4. Watch May open interest on COMEX Silver. May is the next active delivery month. If large buyers are building long positions in May contracts right now, they are loading the next physical delivery demand window into a vault that already sits at 78.95 million ounces and is still draining. 4 data points, all publicly available, all telling you whether this is a paper trap or a structural break. Here is the complete picture. PPI, at more than double consensus, triggered the algorithmic cascade. The dot plot dismantled rate cut expectations for 2026 in one press conference. Silver crashed to $65.45 on paper. The vault kept draining. January delivered 30 times historical volume. February set a record. 578 million ounces of paper claims against 78.95 million registered ounces. The Strait of Hormuz still disrupted, production costs rising as paper price falls. 6 consecutive years of structural deficit with a projected 67 million ounce shortfall in 2026 alone. Citigroup quietly publishing a $150 target. Physical buyers still demanding real metal. Paper can override physical reality temporarily. It has never been able to override it permanently. The mechanism that crashed silver this week cannot refill a vault draining at 30 times its historical pace, cannot reverse 6 consecutive years of structural deficit, cannot reduce production costs while the Strait of Hormuz remains disrupted, cannot manufacture the physical ounces that solar manufacturers and defense contractors need delivered next quarter. The vault data told a different story from the paper price this week. It is still telling it. Verify everything in this video. The CME Silver Vault report is public and updated daily. The IEA Supply Disruption Report is publicly available. The Silver Institute deficit data is published annually. The PSLV NAV discount is live on CEF Connect. COMEX open interest data is published by the CME Group. The data is public, the mechanism is documented. The only requirement is reading the physical market as clearly as you read the paper price. Invest with logic, not hype. Market Crux, signing off. Market Crux, all data independently verifiable, not financial advice.